Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Been covering a bunch of things here regarding, and I was talking about Social Security before the break. This is one of those areas understanding, as I mentioned, the importance of Social Security and what it means to most people. And one of the things I mentioned to you is if you were going to get $30,000 a year, for instance, from Social Security, that's like having a $600,000 asset for a 65-year-old. So it's a very important one to have and represents a significant portion of even affluent retirees' portfolios in terms of what value that's going to be and how you're going to, and how important that's going to be to meet your lifestyle expenses in retirement. I'm going to share some other things from this article with you. One of those being about the Social Security Trust Fund. As I mentioned what the trust fund is as far as these treasuries, these are real assets. However, understanding again that as far as the Social Security Fund goes, but that money, where it's coming from, is coming from that general fund to make up the difference. And where is that money? That's, of course, the income taxes that we pay in addition to the payroll taxes and taxes on Social Security benefits and the like. All of this is important to understand from the standpoint of what value those benefits may be to you in the future. An example would be if you've got, say you're in what will be in 5 years a 25% and maybe sooner, a 25% bracket. So if you're in a 25% tax bracket and you've got in your Social Security 85, and you're getting $30,000 a year and 85% of that is being taxed, that's approximately a little over $25,000 that you're going to be paying tax on. If that's 25%, that's over $6,000 in tax. What did we just see? We just saw our $30,000 benefit reduced to $24,000 after tax benefit. Okay, so this is why it's an important consideration. And think of that year in, year out. Over 10 years, that's $60,000. Over 20 years, it's $120,000 plus inflation. Okay, that's maybe a couple $100,000 lost in taxes out of your Social Security benefits. Have you factored that in? So when you're looking at those Social Security statements, are you looking at after tax or gross? Okay, this is going to be an important factor for you when it comes to your planning. Social Security Trust Fund, understanding how it's set up since its inception in 1935, how it's changed, understanding in benefits. Social Security paid out $1 trillion in benefits during 2019, almost 1/4 of the entire $4.4 trillion federal budget. And that's one of the issues, is how much of it is made up. 86% of that for Social Security benefits, 14% for the Disability Trust Fund. When will trust fund run out? So according to this, that could be anywhere from 2035 to 2042, depending on which numbers you're looking at. Likely, you're talking about somewhere in the next 15 years, okay? Unless government acts to do something to basically raise up retirement age again. That's one of the likely fixes. So people are living longer, so we just saw them raise, for instance, required minimum distributions from 70.5 to 72. We probably see some things along the line. So in particular, if you're in your 40s and 50s even, possibly this is going to be an impact that could have an impact on you as they look to changes. Payroll taxes, another one likely to raise the cap or take the cap off completely, and maybe even raise the percentage in terms of those payroll taxes to make sure we don't run out and that we can keep up with the obligations that we have as we've paid into these funds. Are the bonds held in the trust funds real assets? I addressed that a little bit. This again, yes on the one hand, but again, where's that money coming from? It's kind of left pocket to right pocket a little bit. Does it mean government is raiding Social Security? That's a term that's been used, seems to be a little bit more provocative. Reality, they did that a long time ago. Payroll taxes, had those payroll taxes been in fact set aside into being able to invest in any way they want, like in the stock market as an example, could have probably grown those funds dramatically more. As it is, it's been in these special issued treasuries, so quite a bit different in the way that works. And then understanding too, there's something called public debt versus gross debt. This is kind of interesting, I think, from the standpoint of understanding how the debt thing works. When we look at the way the accounting is done with our government and how they're able to kind of play with the numbers a little bit, keeping in mind basically this. Our country, of course, is one of the safest places for money. It's one of the places people typically would like to buy our debt from because of our GDP and how productive we are. As long as those things keep going, a lot of the stuff that's been implemented, a lot of the things we've seen over this last 4 years with the Trump administration has been things about reducing taxes. And this is when it comes to fiscally, okay, when we're talking about that, tend to be more on the conservative side. There we want to really make sure that we can pay off the debt, that we're not just pushing the can down the road to where our kids and our grandkids are going to be stuck with it, and what that might look like. And think about this, if we're sticking them with the debt, okay, and the Social Security Administration, the way that those monies are paid out or pay as you go, in other words, it's current payroll taxes going in to pay for the retirees currently, okay, how is that going to look then down the road if we've increased this debt and we have fewer, in particular it affects us to where we have fewer workers paying into the system? What is that going to look like? Where's the money going to come from to meet all these obligations? In particular, when intra-government debt is about $6 trillion, whereas the public debt is about $21 trillion. So of our total $27 trillion, 21 of that is public borrowing and stuff. $6 trillion is in the government, which is the Social Security fund, for instance. One of the things that this shortfall, this is why the government's not going to allow that. They're not going to have people up in arms. So they're going to have to make the changes. It's what that reform is going to look like. And when it comes to planning, this is one of the roles for financial advisors, for your advisor, and hopefully, this I'm helping you if you don't have someone that works with you in this kind of more comprehensive approach as opposed to just dealing with your investments. It's important that you understand these because it's going to have an effect in terms of your planning and how much you need to make on your money. Understanding what the needed rate of return is, arriving at that number, and then how can I minimize risk so I don't get myself behind the 8 ball there, right? Remember when we talked about sequence of returns risk and the effect of that? So to help with this, I'm going to again throw out my offer for, if you'd like to call the office, if you need some help, if you've got an advisor, the goal of this is to get you thinking, get your concerns up to where you have that conversation with them. What are you going to do to make sure you're able to overcome these risks, that you have a plan for the risk to minimize or eliminate them altogether? If you need some help with that, just call my office at 615-376-5325. We'll do up a comprehensive plan for you that includes the consideration of all these different things, the different types of risks that you're going to be dealing with, and having a plan for them so you don't have to worry about running out of money. Basically, we want to make sure that you're able to attain and maintain your standard of living and quality of life no matter how long you live, never have to worry about running out of money, being able to thrive in retirement, right? Enjoy those retirement years, not just getting by, not just surviving, right? Not just paying the basic bills and not having any fun money as an example. So if you'd like to have that kind of planning, we're going to look at Social Security, Medicare, how the choices you have to make there, how to minimize costs, minimize taxes, maximize the benefits that you're going to receive there. We look at your investments, of course. We do an investment analysis. We'll pull Morningstar reports. I'll be able to show you hidden risk in your portfolio you may not be aware of. We look at not just what funds you have, but what's in those funds, a much deeper look, if you will, dig down deeper into those funds to show you the potential risk there and how you can then change those funds maybe into something with less risk to protect you in the next bear market. And here again, unless some major things here that I don't see, and it could happen, of course, we don't know. I don't have a crystal ball, but my concern is that we enter another bear market sometime in the next 2 to 3 years, and the potential for a recession is higher. And the bubbles, when we look at, and I'm going to share some, I do a lot of reading, as you see, with this pile of papers all around. This was another one that I found to be very interesting. So think of some of the things going on now. And I know I'm throwing a lot at you today, but I really want you to grasp the importance of these things to you in terms of your planning and some of the changes that could be happening and some of the potential risks out there. I know I have clients all the time, new clients coming in. One of the big concerns they have, one being inflation, of course, what's going to happen there, the debt, how's that going to get paid back? What effect might that have? The markets, are they going to, about the next bear market, about the potential for another recession, how high are those and what might that look like? Now here's one, when we look at the debt, we've talked about that in particular with the stimulus packages and some of the different things going on there. Here's another one. How about QE? Okay, when we talk about quantitative easing, the monetary policies that our Federal Reserve is following with Fed buying, what effect that is having. That's one of the reasons the market is as high as it is, because of this low interest rate environment that the Fed is doing and in buying up the debt and doing the things they're doing. That's what we call quantitative easing. So what might that look like to you? Well, according to a couple of some research that's done here. One of these was Société Générale, a bank, the international bank for, I think it's France on this one. So SocGen and analysts using a mix of weekly macroeconomic indicators running back to 2005 were trying to figure out, estimating the effect of the Fed's bond buying effort on the benchmark 10-year Treasury note. And they concluded that QE likely knocked around 180 basis points, 1.8% off the 10-year yield. So think about that. The 10-year yield is just gone from about 0.5% up to over 1%. They're saying it would be about 1.5 to 1.8 more. Now there's another part to this. What effect is quantitative easing having? How much is it affecting the markets? We know it's strengthened, and we know it's caused, it's one of the reasons for the stock market to be going so strong. Question is, how much, and that means when it goes away, how much might that affect the market in a negative way? How to plan for that. First a break, join me here and I'll get into more detail about that right after this break. Join me here, we'll be right back on the Retirement Report.